Hello and welcome to the Monday Call. I'm joined by Mark Brooks, Chief Investment Officer at NZ Funds. And as the third quarter draws to a close, we look back on the perspectives we shared at the mid-year, which is around 7th of July. We're right to remain confident growth prospects for 2025 have continued to propel markets higher, and our outlook stays positive for the rest of the year. So I think, Mark, how should we think about positioning is probably where we'll start. There's headline grabbing volatility, but we do hold a constructive view of markets. There's other alternative assets we can invest in. There's history that we can go back into, and
Yep.
and as we always say in all of our communications, that markets don't repeat, but they do rhyme. So I guess the way that we can go through this is before we started recording, we thought, what are five things that we want to talk about that are driving markets? So should we start with the markets,
Yeah.
um,
It's
how they're performing, what's going on since July, but also
the
the
year to date,
the year
etc.
to date,
Yeah.
yeah, and then we can go from there. But there's some really great things to talk about. I can't believe everybody says this every year, but it's already halfway through September. But it's a good, I guess, milestone to think about towards the end of the year and then into next year, and not getting too overwhelmed by volatility of headlines and more focus on what's important when markets are concerned.
Yeah, exactly. I think it's a good way to start. So, morning everyone. I think if we go back, if we look at markets uh, and think about what how we started the year, the view was very much that yeah, still thought the US would be a good place, but we'd see I suppose a more diverse, a wider range of returns. That was the expectation this year. And if we sort of sit here today, it's sort of, at the end of September, that's really been the case. I think if we look across share markets, um, in many respects, on a year to date, over the last 6 months, the US has probably led, but year to date, the US is not being the top performer by any means. And actually, at the margin, you could argue that the US is slightly lagging. I think, the MSCI World, that sort of index of developed markets, is up about 14%, where the US is up sort of 12 to 13. So there or thereabouts, but it hasn't been the standout, which it was, in 23 and 24. Yeah, basically you needed to
The
own
only game just
seven.
was US, wasn't it?
You know,
Oh, the only game field was the seven stocks. Yeah.
and if you didn't own those, it was really difficult. Whereas this year it's been a much more, I suppose, well-rounded. I don't know if that's the right word, but a much more, a broad-based move. You've seen US is clearly up sort of 13, 14% for the 12, 13% for the year. Nasdaq has more recently powered ahead. So that's sort of in the sort of higher teens. But then you go to other markets. I suppose Europe has probably more recently actually kind of slightly underperformed in the last 6 months, but year to date is still up 10 or 11%. So strong performance there. And then you go across Asia and emerging markets, especially very strong performance. Out of places like Japan are in the what is Japan? That's sort of 15%, is it? Yeah, or a bit higher. Somewhere like China, depending on where you've been onshore or in Hong Kong. Numbers there again are in the mid-teens to mid-20s and even 30s in some places. And places like, we don't have large exposure to it, but a place like Korea, uh, a share market which is really dependent on global trade, is actually, up 40% this year, 40% plus. So uh, those are pretty good numbers generally.
And weren't they really hit in the tariff announcements at the
I
start?
think they were.
Yeah.
Yeah. I'm by no
Yeah,
means, I'm
but
by no means an expert on Korea. So
I couldn't quite see it on the sandwich board that Trump held up, but I'm pretty sure but like you say, we're not experts, but they are an export nation,
yeah,
and
very much so.
and yet their market's up 44% this year.
And unfortunately, once again, one of the laggard amongst that group, uh, certainly of sort of the what we'd consider the major nations, and New Zealand's not a major nation, but it is for us. New Zealand's effectively flat this year, hasn't had strong performance, and there's plenty of reasons for that most people know in terms of GDP and etc. But I think one thing that is really interesting is if we look back over the last 6 months. Yes, year to date, New Zealand share market is broadly flat. It's slightly positive, but the last 6 months it's actually up over 8%. So, um, yeah, I think share markets and probably if I go back a step, why have markets been positive? And probably why is the New Zealand market positive over the last 6 months? We know if share markets are forward looking. It's not about what happens today, it's about what happens next year and the year after. And, I suppose if we can probably get on to New Zealand more, but, overnight we saw the third reading, the final reading for US Q2 GDP. Um, and they go through, they sort of confirm the
Keep
numbers. So,
revising,
yeah,
keep
yeah.
revising.
And it got revised up quite significantly, 3.8% for Q2. That's a
That's a
that's a
GDP number.
that's a pumping number. And I think forecasts for next quarter are sort of in the mid twos, even with tariffs coming through. So, um,
I know you get these silly sayings in markets, but is the reason why, the reason why markets go up is there's more buyers than sellers and all that sort of stuff, but is the reason why it's so broad-based because people are broadening out of the US and buying these other markets? So when I look at this list, I mean, Germany is powering away
yeah,
this year. And is that because we got so wrapped up in the US market for the good reason, and the tariffs were a bit of a catalyst for us to think, actually, there's other markets out there that are a bit cheaper. Let's buy that. Is that generally been the theme of why all markets have gone up, and perhaps they haven't quite reached New Zealand yet, but they will, and then maybe that's the segue into it. But
yeah. Look, I think there's a couple of factors. Clearly, if we think about the world and financial conditions, and at its simplest, are financial conditions neutral? Is the foot on the accelerator or is the foot on the brake? Yeah, generally, I'm not sure you'd necessarily say that uh, the foot's on the accelerator, but definitely we've gone from a period where the foot's been pretty heavy on the brake in terms of high interest rates, be it here, be it in the US, be it in Europe. You've had that. So definitely interest rates have come down in most places, not so much in the US, but yeah, Europe, they're a lot lower. New Zealand, they're a lot lower. Somewhere like China, super low. Uh, you look at fiscal activity. Yeah, I heard an interesting piece uh, earlier today on another podcast where they sort of compared. We think about where we started the year in the US, threat of tariffs, and then Doge, and basically reducing spending. And this podcast made the comment that Doge was a bit like your New Year's resolution, lasts about 6 weeks.
I actually, once I think about it, I don't think I've heard Doge
No,
for a very, very long time,
so you've got more spending in the US.
other than the remnants of Dogecoin.
So you've got more spending in the US, yeah, Europe again, defense spending and stuff like that. So I think that's why markets outside of the US are up, is actually there's been that sort of loosening of financial conditions. The other one, and doesn't necessarily get talked about too much, but yeah, the US dollar is weaker, and it probably is a trend that we should expect to continue for a period of time. Yeah, the US dollar broadly has been going up for 10, 15 years, and it is very strong. Over the last year, it's down about 10% on a sort of a trade weighted basis, on a TWI basis. And that has quite big implications for different investors around the world. So if you're, probably in the extreme with Europe being up broadly 10%, the European market, and the US being up 13, if you're a European investor investing into the US on an unhedged basis, so being exposed to the currency, you're flat this year, zero return. If you're a US investor investing into Europe on an unhedged basis, you're up 20. So I think there's a lot of that sort of people.
So it's not just overseas investors broadening their market exposure, it's US investors seeking
I think there's some in
seeking
it, yeah.
broadness.
Um, yeah,
Because what a trade that was.
yeah,
European stocks unhedged.
yeah, exactly. And yeah, it's probably been one of the things that's been not certainly hasn't probably been from this part of the world, but in Europe and in indeed lots of parts of Asia, people have brought US assets for a long time and not hedged the currency, and now they're starting to do that. And so basically, it sort of says that I think, as we touched on before, last couple of years, the only game in town was US tech. That's still a really important area of the market, but people are sort of saying, well, actually, we can get equal, maybe better returns elsewhere.
So summarize broadness of markets. You've had a almost all boats rise
Yep.
with a rising tide as interest rates come down, apart from New Zealand, to a lesser, or at least to a lesser extent.
Yeah.
Um, let's talk about New Zealand. We are lagging performance year to date. I think it's the only one that is lagging on that list. But like you said, the last 6 months have been relatively strong.
Yeah.
Should we talk about, what's happened, but also prospects and what's happened? And I think there's been some earnings results out recently that we can perhaps touch on, at least from a expectations point of view.
Yeah. Look, I think there are a couple of things happening. Obviously, we had Q2 GDP last week, which was actually week before last, 2 weeks ago, which was ugly, I think, and it's been really well reported. I would probably say that was Q2, so it is backward looking.
Is this a weird way to think about it? I said this when I was meeting some of our clients the other day. It's almost I was almost pleased with that
Yep.
number because it was the capitulation we all needed to go, "Right, interest rates are definitely coming down to the lowest point of expectations. We can then put a line in the sand and move on, and actually this is really good news, even though it's not really good news." Is it
Yeah, look, I think
from a market's perspective?
I think we're now at a point, and especially with interest rates, where I'm not actually sure further interest rate cuts are going to do a lot more. Yes, they will at the margin, but there's been a lot of cutting that has happened and it's coming through. The bigger issue is probably that confidence one, which is to your point. If we go to somewhere like, if we look at, say, again, come back to that idea of what's happening to financial conditions. If you go to somewhere like the US, a lot of the different measures of financial conditions will actually have share markets performance in them, because that is, a lot of people, I can't remember the figure, but broadly, and I'll make these numbers up and to keep it general, but probably at a national level, 80% of people's wealth is in stocks, 20% in property. So what happens to
This is
stocks?
401k.
Yeah. Yeah. So that wealth impact from the share market is really important. It makes them more confident to spend. They get that confidence. Here, I think and probably one aspect I've slightly missed in terms of thinking about the economy is, I think, with the housing market being so slow for so long, even though interest rates have come down and it's taken time to feed through, but even though they've come down, there hasn't been that sort of underlying confidence that people have felt, well, actually, I might be paying less for my mortgage, but actually my house is worth less.
And
So they're
and
not
so they
doing,
just so they pay down debt.
yeah. So they're,
Yeah.
just sitting on their hands. And I think you need that, kind of like you say, with the really ugly GDP, it sort of need that boost, that shot in the arm. And I think, hopefully, we've seen it to a degree. The Reserve Bank last time cut 25, but definitely changed their uh, discussion, their rhetoric about they were going to bring stuff forward a lot, and opened up OCR moving down another 50 basis points to 2.5%. And probably post GDP, it's likely to go a bit further. And I think that's good. It's just that little tap on the accelerator, which I think the economy needs. And yeah, we are seeing it. I think you are seeing um, some early signs of positivity out there. And clearly, is a little surprising. Yeah, the rural sector is all guns are going there. That's been great. It hasn't filtered through the urban economy.
And is that the I think we discussed this a few months ago, but
Mm.
that is because that profitability that farmers are definitely experiencing has been used initially to pay down debt, but that will only go so far, and then people move on and do need to grow and replace
Yeah,
equipment and all that sort of stuff that
and, and
sort of has that multiplier.
and you are seeing that. I think in one of the banks runs a regional sort of survey, and Bay of Plenty's the most positive region at present. Things like kiwi fruit, other agricultural exports out of that region. Yeah, starting to see it in house turnover, starting to see it in motor vehicle sales, things like that.
Yeah, it's interesting. It's not that we're looking for companies to announce this huge rocket in profitability either. And I think the Hellenstein's Glassons result was a really good example of this, where it in my view, and we've got analysts covering it, so what do I know? But in my view, it could have gone either way. And it's a retailer in a tough market environment, and I think everybody was sort of just expecting it to be tough. And not only were sales pretty strong, yes, a lot led out of Australia, but still
Yeah.
pretty strong. But they said, and market conditions were not as bad as expected, or something along the line. So it's not that it was hit the ball out of the park, but it's just that slight change in
Yeah.
trading expectations looking forward.
And I think, again, we've talked a lot at different points on the podcast about expectations and how, yeah, ultimately are a market prices are an aggregate of people's expectation. So if expectations are really down, you don't need to have a fantastic result. It just needs to be better than what people expect. And expectations are really low. I think a good example is ASB have published their sort of quarterly investor confidence number. And that's, I think, at a net -1% at the moment. It's down 6 quarters in a row. It's not, at the levels we saw during COVID, etc., or periods like that. But typically, and actually COVID's probably a good example. Um, I think the net then was, yeah, -25. Sort of the on net people were -25 in terms of confidence. Um, Following 12 months return was 22% of the New Zealand shares.
Go figure.
So people need to remember, and as I said, share markets are forward looking, and that's why they're up this year. I think is that this increasingly, the expectations were low, but people have started to build in um, better forecast, build in better expectations going forward, and hopefully New Zealand will be like that.
And when we think about the positioning within the inflation part of an NZ Funds portfolio, so the defensive shares and the growth portfolios, those New Zealand shares we think are pretty well positioned to give some, uh, you know, when that happens, 5, 6, 12, 24 months, but we'll look back in 2 years, look at the valuations where they are, and be really pleased we positioned now for that increase.
Yeah, look, at the in terms of the broader portfolios, the inflation ones, we don't. They're very much a sort of a smart passive approach. So they're quite structured and what they own, and those names don't really change a lot. But in terms of say the wider growth portfolios, we've been positive on New Zealand. We have been more focused on cyclical names, and in the shorter term, that's been more challenging for that part of the portfolio. Is that we've probably underperformed even a flat market, but those sorts of names, I think, have got a real ability um, to do well. I think we saw a commodity business, um,
Well,
Vulcan Steel recently, and they just sort of reiterated, remember that basically you've got a very high fixed cost base generally in that type of business, and when times are difficult, you get prices are lower and volumes are lower, so you get sort of a double whammy of margin and volume. But on the other side,
goes the other way.
when times are better, your volumes increase and the prices you get increase. So you get a double whammy.
The good quiz I always give uh, people when I'm talking about New Zealand market at the moment is that expectation thing is Fletcher Building. I think Vulcan Steel is another good example. But given the economic environment, what do you think the share price has done year to date? And it's actually up over 7%. I forget. I haven't looked in the last couple of days, but last time I looked it was 7.5%.
Yeah.
And I don't think that's a reflection at all of the negative 0.9% GDP number last week. It's a reflection of green shoots emerging and, like you said, the
Yeah.
operating leverage that these businesses have, and that's what we're invested in.
Yeah. And then look, those green shoots have emerged before and not come to anything. So, but hopefully this is more of spring is properly embedded and we've got some summer weather coming. Let's hope.
At least hope for the summer weather.
Well, look, again, the nice thing about New Zealand is, yeah, a whilst you wait for that, generally New Zealand companies pay a really good dividend. Two, it's really tax effective. And again, if we think about the flip side of what's happening in terms of interest rates, well, that's great for mortgage holders. If you're sitting there in term deposits at sub 3% or 3% and then paying full tax, that's a real challenge. Whereas, certainly New Zealand shares are very tax effective.
Should we move on to GDP? So we've got that as a pretty high level discussion point, but this sort of follows on from, I guess, what you were saying, because in the end, yes, things are backward looking, but the share market reflects the forward looking economic conditions of the country.
Yeah. And especially in New Zealand, sorry to interrupt, but yeah, if you buy the US, you buy 30% of that market's tech. You buy New Zealand, what are you buying? Some very economically sensitive names. Yeah. Gentailers, Spark, Fletcher Building, Ryman, those sorts of names. Very dependent on what's happening in the economy. They can't they're not going to drive their own um, destiny to the same degree that yeah, a, a technology company might.
So you talked about US GDP being incredibly strong, 3.8%, was
Yeah,
it last in the second quarter?
that was second quarter. So
So how does it compare to New Zealand? We talked about that decrease, but you had some interesting steps because it's not just GDP we look at.
yeah, well, I think again, as I said, that real challenge is trying to work out the difference between what's happening in the urban economy and obviously rural has been really strong. And I haven't got the numbers in front of me, but along with that minus 0.9% GDP number that came out, um, again, remember there was a plus zero point 0.8 in Q1. So obviously it's probably a bit of uh, movement.
Evening it up.
Yeah, a bit of some obviously got pulled forward to 2-1 from Q2 to Q1 and then vice versa. But the other one that was really interesting is and we know it, we hear it, you see people talking about butter prices, etc. New Zealand's had a massive terms of trade shock. So basically, the prices we're getting for our exports are much, much higher. And I think actually in the quarter we're up like 2% or something. So it does mean, and economists will look at it different ways. GDP is a measure of saying what is produced in New Zealand over the quarter. You can look at it as another one, gross domestic income, which is basically more of a cash flow type discussion of how much were we paid and how much did we pay out to others. And often we're paying a lot more out to others because investors in New Zealand live elsewhere. But again, this quarter, really big numbers, and mainly because the exporters are getting paid a lot of money. So that's money coming into the economy, which is, it's got to be positive.
Yeah, absolutely. In the end, cash is king, and
Yeah.
it's probably is perhaps cash is a bit more forward looking than the actual run through into what that means for growth.
Yeah, exactly. So, yeah, again, we've been positive on New Zealand, on the New Zealand share market for some time. Um, we've been too early, but yeah, we do think that economic pickup's coming. The other thing we're very conscious of, and you touched on Helen Sloan's Glassons earlier, we think that's a great business. We have uh, a relatively small position in our main share fund of about 2%. That took us 6 months to buy.
The
So,
liquidity is
yeah.
just insane.
And so the flip side of that is when the market in inverted commas, decides to buy New Zealand, it's very hard to get it. So, what happens? The price goes up and might go up very quickly.
And often that can be a whole number of things. One of the big drivers of the market in the past is the Australians come here because it's cheaper than Aussie. They're positive about the market because they
Yep.
see these green shoots. It's cheap, and they think the currency also might strengthen. And all those things look like they're sort of bottoming out. That if you get a flood of Aussie uh, money into the New Zealand market, that would move it quite dramatically, quite dramatic and quite fast.
Yeah. And you have, you sort of touched on, New Zealand dollar versus Aussie is a very interest rate sensitive exchange rate. And with our interest rates being a decent amount lower than Australia's, that we've seen that cross fall quite a bit. So yes, from a point of view, if you're an Australian-based investor, and again thinking about that unhedging idea, you're buying New Zealand assets at a level you think New Zealand the Aussie's buying a lot for New Zealand at the moment, and you think that the return can happen, that both the New Zealand company will do well and the economy will do better, so that currency will move higher. That could be a win-win. I think, yeah, again, that's, we haven't sort of touched on the New Zealand dollar, but it is,
That's a good segue. That's our next topic. So let's talk
yeah,
about currency.
um, yeah, that's been, I suppose, a yin and yang year, and to a degree, that's sort of makes a lot of sense because if you think about, yeah, the domestic situation has been poor, so economic growth has been below the rest of the world. So from that point, that weighs on the New Zealand dollar. If we think about interest rates, they've moved more lower faster here than elsewhere, especially moved lower versus the US. So that weighs on the New Zealand dollar. But the two other aspects is that the US dollar is decreasing in value, so that all things being equal pushes up Kiwi. And the last one is that generally the New Zealand dollar is what I'd call a risk currency. When people are positive and risk assets, shares, etc., are going higher, currency tends to follow as well. If you get a big negative event, share markets fall, New Zealand dollar tends to fall versus the US. So you've kind of got competing forces there.
Do you want to talk about our positioning in currency? I think I guess what I wanted to focus on just quickly is you made that really interesting point around if you are a uh, a European investor holding US shares unhedged, although your shares have gone up
Yeah.
10% or a bit more than that, you've had a zero return. How do we think about the currency in this perspective? Because our shareholdings are different from our currency views.
Yeah. I think very much within that discussion for the New Zealand dollar in terms of our offshore holdings is, we are fully hedged. And it's really that view that actually do expect New Zealand probably to do better in terms of economic growth. So the story for New Zealand gets better. And also, and more importantly, US dollar has been through a very long uptrend. There are some real reasons for people to at least maybe not sell US assets, but at least with their buying US assets to say, well, actually, I want to hedge the currency, which, if you don't hedge, say for a New Zealand based investor, if we're not hedging and we're buying US assets, you have to go and buy US dollars to buy those assets. If you're hedging, yes, you buy the US dollars, but at the same time, you sell them forward to cancel out your FX exposure. Um, and people doing that more generally will put a bit of weight on the US dollar. So, from that point, we are still fully hedged versus the US dollar. So, at the moment, Kiwi's 57 and a half. So, there's been a small opportunity cost to that. We've certainly got the returns out of the shares that we wanted. We do have in the growth portfolios and the international growth portfolios and KiwiSaver growth a position in the Japanese yen. That is really sort of there for two reasons. One, it is that shock absorber when the world is a bad place. So, the yen, whilst New Zealand dollar tends to fall in that situation, often the yen strengthens. It's known as a safe haven asset. So, it's for that reason, as I suppose, a yin to the other parts of the yen portfolio. And the other one is that given where interest rates are and given what's happening in the economies, the US is cutting interest rates, maybe not as fast as people has expected. Japan, they have inflation. They've wanted to create inflation because they haven't had it there for many years, but they do have inflation and they still have interest rates at very, very low levels. So their path going forward is to slowly raise interest rates, which narrows that gap between the two. And it does mean that you've got um, US dollar, yen, the exchange rates, round up about 150 yen to the dollar at the moment from a purchasing power parity framework. So, two assets should be able to be purchased for the same value and regardless of currency. For that to be effective, to work, to be true, the yen should be closer to 90 to the dollar, not 150. So it
Whoa,
is a massive.
massive.
It is by
If you
far.
put that in the best way to put that is the Big Mac index.
Yeah, basically, yeah. Um, you it is by far and away the currency that is the cheapest and needs to go up. Yeah, basically almost needs to go up 50 or 60% to flatten out that cost of the Big Mac.
I love that. They put in The Economist, don't they, on the cost of Big Macs in various countries, and that's a great example of that currency play. Although I guess that's been there for a while, but now that they have inflation, interest rates should go up, and therefore the yen should start
Yeah.
strengthening.
And you're seeing interest rates in the US come down more slowly than people expected, but they are coming down.
On currency, and it's sort of a some people consider it a commodity, some people consider it a currency, but should we touch on gold?
Gold.
We've talked about gold on this podcast around how we invest in it from an overlay perspective. It's got great attributes like having low correlation to shares, and therefore you can create additional returns for a lower proportion of risk.
Yeah.
How do we think the question I'm getting asked a lot from our clients is gold has done incredibly
Wonderful.
well.
Yeah.
I remember uh, selling some gold to my detriment when it reached 2000 because I just wanted to say I sold gold at $2,000 an ounce, and now we're
Now you can sell it at 4,000
4,000.
almost.
Exactly
Yeah.
right. So when we've portfolios have benefited greatly from that position, it's been a wonderful um, position that you've had in the portfolios. How do you think about it now? In the sense of, is there more to come in gold specifically, but also what do you think about it when assets do this well?
Yeah. Um, Look, yeah, as you touched on, gold is probably close to one of the top performing assets this year, sort of depending on the day, sort of 40% or more this year. So well ahead of many share markets, even the most buoyant share markets. And it was actually the second or third top performing asset last year. So it has gone up an awful lot. Uh, and in terms of has it in terms of whether it's got more to go, I think what we want to do is generally think about the drivers of an asset, especially because if you're looking at a share, it's all about what that company can earn. Gold doesn't earn you anything, so it's more a discussion of where is the demand and supply coming from. And we've talked before that yeah, gold's been through some different phases. Really, we'd sort of see it as being three very broad phases. 1974, the US left the gold standard. Up until that point, you could exchange your US dollars for gold on a one for one basis. Um, Nixon left the gold standard. Uh, at that, pretty much from then, 74 through to 2000, gold was a very good inflation hedge. It followed actual inflation really well. Um, Mainly because people, your typical buyer, well, the way to buy gold was to physically buy it. So it was sort of retail buyers buying it, putting it in there.
You can buy it at Costco.
Yeah, exactly. The old Krugerrands and stuff like that. In 2000, you had the advent of two things. One, gold futures. So, yeah, market professionals like ourselves didn't have to buy gold physically. They could buy a contract on the gold price. And two, ETFs, exchange traded funds. So you could buy a fund that purchased the gold. So that really opened up, yeah, what is a pretty small market. Gold is not a big market to a much bigger group of investors. And really, from 2000 through to the Ukraine war, it became very much driven by professional investors, and they're ultimately because gold has no um, uh, yield, no income to it, very interest rate sensitive. So, it followed the path of interest rates. In
Meaning if interest rates went up, gold would go down because you might as well put it into
Yeah, you were getting
US
paid
gold.
more elsewhere.
Yeah,
And if interest rates went down, I'm not getting hurt as much by buying an asset that doesn't.
give you a yield.
Yeah. So certainly, that had the and that also makes sense in that environment when interest rates fall often, things can be difficult, and gold does pretty well during difficult times. During the sort of post-COVID, Ukraine war start, etc., very much a case that interest rates went much higher, as we all know, uh, but actually gold price didn't go down like you would have expected it to over the last sort of the prior 20 years. Why? Um, as we've talked before, central banks buying gold because actually they were worried about having reserves in a US, frankly, in a US banking system. Whereas if they held gold, it was outside of the control of the US banking system. And after Russia's reserves being frozen post Ukraine, that really that doubled their demand for gold. So you had essentially there's not much supply of gold, a lot more buyers, and from a relatively price insensitive group. So that's a key reason why gold's been going up so much over the last couple of years. And then the other one is, we've also seen interest rates falling. That means the professional buyers, the likes of ourselves, are also more incented because interest rates are lower. Um, are those patterns likely to change? It's hard to see them changing in the short term. Gold's come a long way and a lot of people own it. So it probably makes it at the margin a bit more susceptible to risk off events. We'd excited. And we did see that in March, April with the tariffs that on that initial news, actually gold went down. And that's because a lot of people own it and they just needed to reduce their risks. But it's bounced straight back. So, we think it's got a great part of it's got a great role in the portfolios, as you touched on, as a diversifier and as a risk management asset. And we think it's gone a long way, but would we see 4,000 at some point? Yeah, we definitely think so.
It's so we don't have to touch on it today, but that description around currency and the effect that government policy and interest rates can have on it, and therefore the driver of gold price
Yeah.
is almost identical to why Bitcoin has also been driven higher.
Yeah, exactly. Yeah,
And
gold
partly regulation
and
too,
gold
but
in many respects is the ultimate of truly transferable asset. Yeah, if you own a share, yes, you own it, but can you actually put it in your bag and take it off to an island somewhere? You can't. Whereas gold, you can. So, and Bitcoin to a similar-ish degree, you possibly can. So, yeah,
bit easier to store Bitcoin.
yeah, correct.
I think
What haven't we
that's
talked about?
uh,
China.
yeah,
Yeah.
it's an interesting one because gold was, the flavor of a lot of developing markets, and now it's very much mainstream
Yeah.
in the sense of, uh, you know, the institutional uptake and the ETF uptake. It's been phenomenal, which is, talking about the same, sort of in the same way, China has always been known as a developing market, but it's really not. It's a developed market, and it's something that we have a decent sized position in the portfolios. And do you want to talk about it? We have touched on it in the past, but do you want to remind us
Yeah.
what the thesis is?
Um, the nice thing about China, I think, is the thesis has many levels to it, which is really positive. Probably the first one is, China has been experiencing its own version of the GFC. We've talked about that a fair bit. The property price issues there. What is often what even we forget is this started over 7 years ago now. Basically, the first, and it was engineered. There were directives from um, the um, the party, the Chinese Communist Party, to stop lending, to reduce lending to the developers back in 2018. Excuse me. Um, from that point of view, it was self-engineered, but it probably became worse than they expected. But it's been going on for 7 years. You've seen y- y- definitely the issues there are well known, priced in, and they're working through those. At the same time,
Which is really positive.
yeah,
Not bailing out the developers is a good thing,
yeah.
not for those developers,
Well,
it's for the market function.
again, I think, probably what people don't realize is those banks and etc. were told, you shouldn't be lending as much to developers. What were they told to do? To lend to industrial businesses. That's why you see BYDs on the road here. That's why you see MGs on the road here. China's become the largest car maker in the world, uh, in a way because of those decisions to say, well, actually, we've got too much property. We don't, doesn't need to be the focus of the economy. we need to find more domestic productive industries to back. And yeah, that's why you look at around many areas, all their work in EVs and solar and EV batteries in cars and etc. A lot of that's actually come out of those decisions. Um, so that's one reason that we're positive. We think that actually that process is, yeah, the negative impact of property is in price and diminishing. I think, yeah, two, a bit like that confidence issue in New Zealand, one of the interesting dynamics in China is that there is no social or a very limited social safety net. People have always saved a lot. Um, that's People have massive savings and they have spent some of it post COVID, but it's still they haven't put a lot of that savings to work because, like New Zealand, there's been a lack of confidence due to property. But if we look at some of those numbers, saw one stat, I think you've got a similar one, that if we look at, say, term deposits in China, there's a lot of, because of that lack of confidence, there was a lot of people put a lot of money into term deposits in 2020, 2021, 2022. That's starting to roll off. And basically, they were doing that. Those, they did that at much higher interest rates, just like you could in New Zealand at the point in time. Now they're getting numbers that are 1%, one and change. So it's not much incentive.
So they have something like a 35 to 40% savings
Yeah.
rate, and it was all going to property. Then it's now all going to the banks, and they were getting 3%. Now they're getting 1%. That's a that's a pretty strong story
And
of.
they're monster numbers, in terms of that addition that was going to the bank. The suggestion is that it's about 105 trillion RMB. Now, most people don't really sort of talk RMB, but that's 15 trillion US dollars.
Imagine what they would do to the share market if that all went in there.
Yeah, well, the share market in total is 12 trillion US dollars. So you don't need a lot of it to
No.
go in to go out. So I think, yeah, there's definitely that positive aspect, and clearly, really is in a similar way into which the government was encouraging lending to industrial businesses. They also want to see a prosperous share market because that's actually good for businesses, being able to get capital, being able to grow, etc. And it is part of I suppose, a continuation of China moving from a developing economy to a developed economy. So they really want to see people move a portion of that money to the share market. And whilst Chinese shares are up a decent amount this year, it's actually probably quite still very early in the process. Um,
It's someone, I think it might have been you, Mark, talking about it in terms of what's happening in government policy around China is very similar to the pragmatic way that the US dealt with the global financial crisis.
yeah.
And what happened after that? Well, the US share market went on a 20-year massive bull market
Yeah.
because it dealt with the issues. It didn't just throw money in it. It was systematic with how it dealt with it, and got the economy to a even footing.
And in a similar way, they're using much of the same playbook. In the US, they obviously one of the areas that was a problem where their car manufacturers were bankrupt. I think government bailed out GM, etc. One of the programs where there was their cash for clunkers that you could trade in
That's right.
your
Yeah.
crappy old car and get paid no subsidy to go and buy a new one. China's doing a similar thing with basically with whiteware. Again, if you think about, um, they don't necessarily need to rebuild a whole lot of buildings, but a lot have been built in the last 20 years and are pretty due for a refurbishment cycle. So they're encouraging that with, get a subsidy for a new dishwasher or a new air conditioning unit, etc. So,
That's good for hire who
yeah,
now own Fisher& and Paykel appliances.
exactly. So, um, and yeah, reminds me, probably the other one did want to touch on is, there's markets have gone up a lot. China's gone up a lot. US market's gone up a lot. But actually, if we think about some of the dynamics, one of the questions actually is rather than is this about to end, it's like, are we actually probably at a similar period to what we had in the mid 1990s, which ultimately ended in an ugly fashion at the end of the dot-com boom in 2000, but markets went up 300% in the mid-90s over that time frame. And why do I say that? Just, right, apologies, losing my voice, talking too much. But yeah, why do I say that? If you think about what is happening, you've got, like the 1990s, you had interest rates go up. A lot of this early in in 2020, 21, similar in the early 90s. You had what was known as the bond crash in 94 when put interest rates up a lot. Two, you had clearly, that joint boom between the internet, growth of the internet and growth of wireless and mobile. So we had interest rates go up. You've got a technology boom. Yeah, sounds like AI. And three, you're actually, at different points in the mid 1990s, you had the Fed cutting interest rates in a preemptive fashion. So, the economy wasn't in recession, but they were cutting interest rates in order to ensure that it didn't. The growth stayed. Kind of similar to what we're seeing. The Fed cut rates recently. And they we're careful to say it's not part of a big cutting cycle, but they want to preemptively cut rates because they are seeing some weakness. But clearly, out of GDP numbers, the economy is still strong. So, there's potentially a number of factors out there that, again, markets don't repeat, but there's some similarities between now and maybe the early or the mid 1990s where actually that was a wonderful time to own
I was going
stocks.
to
And
say that you've almost described a nirvana
yeah,
environment for
clearly, it ended
stocks.
in an ugly fashion for investors in 2000 when the dot-com bubble did get extreme. But
But you could say that that wasn't related to necessarily policy. That was sort of a technology sector that was
uh,
unfunded,
yeah,
unlike the current
correct.
AI.
And there is just there are discussions as to whether some of these stocks are expensive. Yes, some are, some I don't think are. And many of the valuations are not dramatically different to what we've seen probably over the last 5 years.
And they all have huge
Huge
businesses
earnings, yeah.
and earnings, yeah.
Um, But you could get to a point where, I'm not saying this will happen, but if the market doubled from here, then yes, they could be truly overvalued. But there is potential for, um, yeah, we don't see that many. We see as probably more positive uh, things on the horizon than we do negatives at this point.
Well, Mike, that's been a really good summary for quarter three. I think, I guess the fast way we could have said that is same as what we talked about 3 months ago.
Yep.
And it's doubling down is the wrong terminology because we're not doubling down,
No.
but continuing with the themes and remaining optimistic on the outlook and not caught up in the headlines.
Yeah. Look, I think the last point I'd want to make is markets have been positive. We do know that once a year, maybe twice a year, you see drawdowns of 10%, even different years more than that. We've had one of those this year. Given markets have been so strong, it wouldn't be surprising to see another one at some point over the next 6 months. But we'd actually see that, I think, at this point as being as an opportunity to be brought to be invested in rather than panic.
Absolutely. In the end, share markets do 7 to 10% a year over a 25, 30 year time period, and that's what we're trying to achieve.
Yeah, exactly.
Thanks everyone for joining us. Have a great rest of your day, and we'll talk to you again soon. And thanks very much, Mark.
Thanks all.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.